Welcome to our channel on accounting lessons with worked out problems. Brought to you by an experienced accounting professor with a CPA. We have videos on all topics of introductory financial accounting. Our focus is on step-by-step illustration of a problem, worked out on a whiteboard. Each topic also reviews concepts at the end if you need to brush up. Please do not forget to subscribe. Inventory accounting is presented in two separate videos. The first video will illustrate inventory accounting under periodic accounting and perpetual accounting methods. It will also illustrate inventory accounting when sales discounts, returns, and allowances are involved for both periodic accounting and perpetual accounting methods. In addition, it contains a discussion of the above concepts in the end. The second video will show inventory costing under FIFO, LIFO, and average costs for both periodic accounting and perpetual accounting methods. In addition, it contains a discussion of the above concepts in the end. Let us begin the video with a description of the problem on periodic accounting and perpetual accounting methods. It will be helpful to have a printout of the problem for reference while you are watching the video.
In this video, we are going to work out problems on inventory accounting. First, we will go over entries for the perpetual system and then the periodical system. And then we are also going to do some calculations on inventory costing, that is FIFO, LIFO, and average costing. First, we are going to work on the perpetual system journal entries. The first entry is, here the company is a retail business that buys and sells high-definition televisions. On January 1st of 2023, the inventory balance was $30,000. Again, we are going to use the perpetual system. So first, we start with the inventory balance. Inventory starting balance was $30,000. The second transaction, on January 8th, company bought televisions for $80,000 and it also paid $8,000 for shipping. So here, you debit inventory for $80,000 and you credit account payable $80,000. And the company also paid $8,000 for shipping. In the perpetual system, the shipping cost to bring the inventory which you purchased goes into the inventory account. So you debit inventory for $80,000 and you credit cash $8,000. The vendor gave a credit terms of 2/10 N/30 to company ABC. So the purchase credit terms is 2/10. That is, if the ABC pays within 10 days, they get 2% discount. If not, everything else is due on 30 days. On January 12, the company returned some units because they were defective and the cost was $6,000. So the company is returning back the merchandise. So you credit inventory for $6,000 and you debit account payable for $6,000. On January 14th, the company paid what it owed. So here, the company it owes $80,000 minus $6,000, $74,000. Since the company is paying within 10 days, the company can take the 2% discount. So first, you debit accounts payable for $74,000 and then you credit the inventory for the discount. The discount is 2% of the $74,000. That comes up to $1,480. So you credit inventory for $1,480 and you will credit cash for $72,520, which is $74,000 of the account payable minus the discount. You credit cash for $72,520. Next one, on January 15th, the company sold some televisions to the customer for a price of $85,000 on account. The cost of the items sold, $45,000. So first, the sales is on account. Therefore, you debit accounts receivable for $85,000 and you credit sales revenue for $85,000. Now, the cost of the television sold, $45,000. So the inventory goes down by $45,000. So you credit inventory for $45,000 and you debit cost of goods sold expense for $45,000. The customer in the above sale is given a credit term of 1/15 and N/30 and company ABC paid the freight out. So here the company ABC is paying the shipping cost to ship the sold items to the customer. So this is an expense. So you will debit freight expense $2,000 and you credit cash $2,000. On January 20, the customer paid ABC for January 15th sale. So here the customer is paying within the discount period, so the customer also gets what? 1% discount. So 1% of the accounts receivable is $850. So first you credit the accounts receivable for $85,000 and then you debit sales discount for 1%, which is $850, and you will debit cash for $85,000 minus $850, that would be $84,150. So these are the entries for the perpetual system. Now we are going to use the same set of transactions to illustrate the periodical system. So now I'm going to erase all these T accounts. Okay, remember, in the periodical system and the perpetual system, only the transactions affecting the inventory will be different. Okay, so here this is the periodical . Okay, again you will have the inventory and it started with $30,000 and we don't update the inventory in periodical system. So again, the first one, the transaction, the company is buying inventory for $80,000 and it is paid $8,000 for shipping. So first we go into account called purchases. So you debit purchases for $80,000 and you credit account payable $80,000. And the company also paid $8,000 for the shipping. So here you go to freight in, debit $8,000 and you will credit cash $8,000. And then the credit term on this purchase is 2/10 N/30. Number 4, on January 12, the company returned some units and the cost of these units was $6,000. So here you debit accounts payable $6,000 and credit purchase returns for 6,000. And then on January 14th, the company paid the amount it owed. So here, you debit accounts payable $74,000 and you will credit cash for $72,520 and the discount is $1,480. So that goes into purchase discount credit 1480. Next one, on January 15, the company sold televisions to a customer for a price of $85,000. Now in the periodic system, the company does not keep track of the cost of the inventory sold. So they will only have the information about the price these televisions were sold, and that is $85,000 on account. So here you will debit accounts receivable 85,000 and credit sales revenue 85,000. Next one, the customer, the above sale gets a credit term of 1/50. Now here the company is paying the shipping cost. So here the entry is the same as the perpetual. So here you debit the freight out for 2,000 and credit cash 2,000. And the last entry on January 20, the customer paid. So here the customer is paying within the discount period, so he gets a discount. So now you credit accounts receivable for 85,000 and then you debit sales discount for 850 and debit cash for 84,150. Now, in the periodic system, at the end of the period, remember, so far we have not recorded the cost of the goods sold. So at the end of the period, the company has to record the cost of the goods sold, and the company will also close the purchases account, trade-in account, purchase returns, purchase discount, and it's also going to update the inventory balance for the ending inventory and then record the cost of the goods sold. So here your ending inventory is 65,520. This is the information the company will get after the physical count. So let us say the ending inventory is 65,520. So here the inventory balance, the beginning balance is 30,000. So here the first one is, I'm going to put those entries in a different color. Let us see. So here the inventory balance should be brought to 65,520. So what we do is, we have to bring this balance to 65,520. And then, so this is, to bring this 30,000 to 65,520, we have to debit the inventory by 35,520. This is the first entry to close certain accounts update the inventory and record the cost of goods sold. Second one, we have to close the purchases. So we'll credit purchases for 80,000. Now the balance is 0. And then we also close the freight in. So you credit freight in for 8,000. The balance should be 0. And then we close the purchase returns. It has a credit balance. So to bring this to 0, you debit purchase returns for 6,000. So this is the first entry, second entry, third entry, fourth entry. Now you also close your purchase discount. It has a credit balance of 1480. So to bring it to 0, you debit 1480. That will be the fifth one. And now finally you have to record the cost of goods sold. So now the cost of goods sold is, remember folks, the total amount you debit should be equal to total amount you credit. So now the cost of the goods sold would be $45,000. And I'm also going to explain this in the journal form, so you will see how we got the 45,000. So here, let's do it. So first, we are going to do the entries. So let us do here. First, what we did was we debited inventory 35,520, and then we credited the purchases. So you credit purchases 80,000, and then we credited the freight. So freight in credit 8,000. Next one, we debited purchase returns for 6,000. So purchase returns, we debit 6,000. And then we debited the purchase discount for 1480. So now you see, these are the debit amounts and these are the credit amounts. So now to bring the debit equal to the credit, okay, your cost of goods sold expense would be $45,000. So now if you add the debit amounts, that would be equal to your credit amount. Okay, next one, I'm going to show you an illustration just to record the sales related transactions.
Next, we will illustrate inventory accounting when sales discounts, returns, and allowances are involved for both periodic accounting and perpetual accounting methods. Take a moment to read the problem. It will be helpful to have print out of the problem on hand.
This illustration is for sales discount and sales returns and allowances. That is when the discount is given to the customer and when the customer is returning some merchandise, how do we account for the perpetual versus the periodical. So I'm going to show you the side-by-side entries for the same transactions. This will be for periodical and this will be for perpetual. So first, the first transaction is on January 4th, the company ABC sold customer A 30 televisions for $800 each. So this is a sales revenue transaction and the revenue is 30 televisions times 800, $24,000. So you will debit accounts receivable $24,000 and credit sales revenue $24,000. And you will do the same for the periodical too. You will debit accounts receivable 24,000 and credit sales revenue 24,000. You can see the entries is the same. Second one, the customer A has a credit terms of 3/10 and N/30 and the cost of the television for ABC is $300. That is, the cost of the television sold is 300 times 30, 9,000. So under perpetual, we're also going to record the cost of the goods sold expense, 30 televisions times 300, 9,000, and we will also credit inventory 9,000. Now, we do this only for the perpetual, but we do not do anything for the periodical. So you can see the difference here. And number 3, on January 8th, the customer returned 4 televisions. So on January 8th, so the televisions are coming back from customers. So now, first, you will debit sales, returns, and allowances. So the customer is returning 4 televisions. They were originally sold for 800. So 800 times 4, $3,200, and you will credit accounts receivable 3,200. And you do the same for periodical too. So you will debit the sales returns and allowances 3,200 and you will credit accounts receivable 3,200. Now, remember, the inventory is coming back, okay? So the merchandise coming back, the inventory increase. Under the perpetual, you have to update the inventory. So these televisions, the cost was $300 per television. 4 televisions are coming back. So 4 times 300, 1,200. So under perpetual, you will also debit inventory for 1,200 and credit cost of goods sold expense 1,200. We do not do this entry for periodical because we don't update the inventory. So now you can see the difference. Okay. At last, on January 12th, the customer paid what they owed. I'm sorry. And number 4. Number 4, the customer were also given a price allowance. So here, you debit again sales returns and allowances for 500 and you credit accounts receivable for 500 and you do the same for the periodical too. So you debit sales returns and allowances 500 and you will credit accounts receivable 500. And finally, the last entry, the customer paid the amount owed on January 12th. So here, okay, where can we do this? Okay, I'm going to erase the first one. I'm going back to the top because I don't have any space in the bottom. So on January 12th, the customer is paying the amount they owed on their purchase. So that will be equal to, so how much will that be? The original was $24,000. Okay, now the customer returned 4 televisions and they were also given a $500 allowance. So the final accounts receivable balance the customer owes is $20,300. So here, out of this $20,300, the customer gets 3% discount. So 3% of $20,300 would be $609. The remaining cash is the amount the customer is going to pay and the company is going to receive. So the last one, you debit cash for $19,691 and debit sales discount for $609 and finally credit the accounts receivable $20,300. So this entry will be the same for the periodical too. So you will debit cash 19,691, you will debit sales discount 609, and you will credit the accounts receivable 20,300. So as you can see, remember, only the inventory is not updated and the cost of the goods sold expense was also not updated for these returns and allowances.
Before we close the first video on inventory accounting, let us review the concepts behind the problems we illustrated.
Now, there are two accounting methods to track the inventory. The first method is the perpetual accounting method. In this method, the inventory account will be updated for every change that is happening to the account. For every purchase of the goods and for every return of the goods and for any cost savings on the purchase of the goods and for the sale of the goods. So these are the transactions that will affect the dollar balance in the inventory account, and for all these changes or for transactions, the inventory account will be immediately updated. So since the account is updated for every transaction affecting the inventory, this method gives the most accurate updated balance at any time. Now, the second method is the periodical accounting method. Here, the inventory is updated only at the end of the period, and that updating takes place after the physical counting of the goods in hand. So the people go out and they count every item left in the inventory at the end of the period. And then the inventory account is updated for whatever the goods left in the inventory at the end of the period. Here, all purchase-related transactions are recorded in the purchases and purchase-related accounts. Here, we're talking about the purchases of the inventory. Here, the sale of the inventory is not tracked. It is calculated and recorded at the end of the period. So here, it will be recorded as the cost of the goods sold expense. And all purchase-related accounts will be close to zero at the end of the period. Now, there are certain things that are common for both the methods. First thing, recording for the sales revenue and all the other sales-related transactions. That means they will record the sales revenue, and if the customers are returning the goods, that is called the sales returns, that will be recorded. And also the collection of the cash from the customers made on sales will also be recorded. In both the accounting, a physical count of the inventory will be done at the end of the period. Now, accounts that are used for both the methods. Inventory. Inventory account is maintained by the companies that use either methods. That is, we need to have an inventory account under both the methods. Sales or sales revenue. This is to account for the money earned when the company sells goods to customers. Sales discount. This is the discount given by the selling company to the buyer if the buyer pays within the specific period. Sales returns and allowances. When the customer or the buyer returns the goods, or when the seller gives a reduction in the original price charged to the customer. So these accounts are common under both the systems. And also cost of the goods sold. This is the total cost of the goods sold to the customer. Under the perpetual method, the cost of the goods sold will be recorded every time the company sells goods to the customers. Under the periodic method, the cost of the goods sold is a calculated amount and recorded at the end of the period. Freight out or shipping expense. When the seller pays for the shipping of the goods to the customer, this is an expense and this will go in the income statement. And accounts that are used only in the periodic methods. Purchases. This is when the goods are purchased for the purpose of sale to the customer. That is when the company buys merchandises. The purchase of the goods, the dollar amount will go into this account. Purchase returns and allowances. When the retail company returns the goods purchased, or when there is a reduction in the original cost the supplier charged to the retail company. Purchase discount. This is the discount taken on the goods purchased when the payment is made within the specific period. And freight in. When the company pays the shipping to receive the goods. So these are the accounts that are used only in the periodic methods. Okay? And all these accounts are related to the purchases and for the payment and for the shipping of the goods purchased. And these goods are purchased in order to be resold to the customers. Now, all in perpetual method, all these transactions, purchase-related transactions, will be recorded in the inventory account. So that's why we said under the perpetual method, the inventory account is constantly updated for any change in the inventory. Now there are terms to remember. First, credit terms. What is a credit term? This is the conditions about paying for the goods. This is the condition given to the buyer of the goods by the seller of the goods. Now it denotes the discount percentage, the discount period, and the period when the invoice is fully due. Example, 2/10 yen/60. What it means is the buyer gets 2% discount of the cost of the inventory if he pays within the 10 days of the purchase. And yen/60 means any amount not paid within 10 days is due within 60 days of the purchase. Now shipping terms. So this is the shipping term that is agreed between the buyer and the seller. Now, FOB, if the shipping term is FOB, which means free on board, and the second shipping term is FOB shipping point. Seller is free of the shipping cost. Therefore, the buyer pays the shipping cost. FOB destination. Here the destination is the buyer's place. So here, the seller pays the shipping cost. So FOB shipping point means the buyer has to pay the shipping cost. FOB destination means the seller pays the shipping cost.
Thank you for watching the video. We hope we were able to help you understand inventory accounting under periodic and perpetual methods. The second video on inventory accounting will show inventory costing under FIFO, LIFO, and average costs for both periodic accounting and perpetual accounting methods. We have video lessons with worked out problems on all topics of financial accounting. Please do not forget to subscribe.